The American waterfall is a little bit different than the European waterfall in the sense that the manager can start participating in profits on day one, or perceived profits, even though the investor hasn't received 100% of their capital back. And that's the biggest difference between the two. Now, it doesn't mean that one is better than the other. The American waterfall is actually more suitable to income funds, debt funds, things like that, things that have a lower risk nature, where there's not a lot of capital risk, where the investment itself might be 10, 15 years in nature, and the capital may not be returned for 8 to 10 years. So in those cases, it's actually fine that the manager themselves starts to participate in the cash flow of the investment on day one. But what investors want to look for is the clawback feature in that. And what that means is that in the event that the deal doesn't go as planned, that there's more risk, or the deal actually suffers a loss and the manager has taken an incentive fee, then in that case, the investors have a way to get that back and have the manager pay them back. Now, the reality is that the clawback feature is only as good as the net worth of the manager. So you can imagine that if you have a manager who has very little net worth or no balance sheet, that the clawback is not even worth the paper it's written on. So I would say that if you are in an investment that might be debt or income, but you have a manager who doesn't have a balance sheet or a net worth, in that case, it's probably more suitable to go with a European waterfall.